It's already almost fourth quarter of 2018, and what in the world is going on in the San Diego real estate market? That is what we're going to talk about in this video, including graphs, year-over-year numbers, and other economic indicators, and what it all means for you as either a buyer or a seller in the San Diego County real estate market. And real quick, if you haven't already, be sure to subscribe so that you're the first to know about future market updates and other real estate content that we put out for you. All right, let's get started. So as you might have noticed, as a lot of people are, the San Diego real estate market has had a little bit of a different feel lately, right? In fact, we've been seeing more homes on the market and more price cuts across the county in most price ranges. Now, let me be clear before we move forward. Real estate markets are local. Real estate market cycles can be local. While many times an entire region will move up or down in unison, more often than not, different neighborhoods will experience the localized market cycles a little bit differently. So for example, when high-rise condos, complexes downtown, they get completed and all the condos are released to buyers, the excess supply would likely have a relatively local impact and possibly stagnate appreciation, while on the other hand, a shortage of housing in a gentrifying area might continue to outpace the rest of the region in appreciation. In other words, there are always buying opportunities, whether in a rising or falling market, and it largely comes down to local factors. Now, we all know that real estate is a supply and demand market, and so that we're clear on what that means, supply is the amount of properties that are available in a given area at a given time compared with the amount of qualified buyers that are qualified, able, and willing, in other words, motivated to buy the subject type of property, right? And here's a supply and demand curve for you, in which, as you probably already know, as demand decreases, supply increases, and as supply goes up, prices tend to decline. Does that make sense? So while 3/4 of the population may want to own a home, many simply cannot afford to buy a home. So we know that affordability is, of course, a very important factor when looking at the market. Now, of course, just because a household cannot afford to buy a home does not mean that they become irrelevant to the real estate market. In fact, they still need a place to live. So while they might remain in rental territory, while they might be renters, they're going to remain in territory which still influences housing availability and therefore supply. Although the makeup of the rental market is not only comprised of single-family homes and condos, they have apartment complexes, etc. And here's a chart for you to help visualize that. So this is a rental housing demand compared with the homeownership rate across the country. So you can see that as the homeownership rate declines, whether due to affordability or otherwise, the rental demand inversely increases. And now let's take a look at some San Diego County housing trends charts to visualize where we currently sit. And in this first chart, we're looking at supply. This graph shows us the number of active listings of detached single-family homes and condos in the San Diego County at the end of each given month, going back over 14 years. So as you can see, at the end of August, we were at around 7,700 active listings, which is over 22% up year over year from August 2017. 6,271 was the number for last August, which is pretty crazy, right? So the reason year over year is so important is because in addition to macro real estate cycles, there are several seasonal micro cycles in the market that we follow as well. For instance, the inventory tends to peak, as you can see, around June, July, and August, pretty consistently in all of these, right? And typically households, they prefer not to move during the school year, which is one of the reasons for this. And in contrast, December is consistently the month with the lowest inventory due to the holidays. So looking at these numbers year over year is the best indicator for objectively seeing where the market currently sits, right? And as we can see, August was not the first month of increases in inventory. In fact, August was the third month in a row with year-over-year increases of 10% or more. So August was 22%, July was 16%, June was 10%. If we want to go back, May was 6%, April was 4%, and March was pretty flat. But so we can just see this is an increasing trend right here. And so what contributes to this? Well, let's check out new listings. And on this chart, what we're looking at is listings that were new and listed for the first time for that specific month. So for example, active listings includes all active listings at the end of a period, whether they were 2 months old or new, but new listings is only properties listed in the given month. And as we can see here, new listings for August were up over 14% right here. Again, we're talking year over year. So we can see this is contributing to that increase in inventory. Now let's also look at pending sales. Now, pending sales helps us get insight into what to expect the following month, right? So we can see here that pending sales are down 8% year over year, 8.7%. And we know that, that wasn't because of a shortage of inventory, because we had the largest number of homes, active listings in August since 2016. And let's take a look at one of the primary indicators that it all comes down to, which is sold listings. And here we can see, if I can pull it up, here we can see that sold listings in August were down around 12% year over year, 12.5%, okay? But as we can see, what appears to be happening is that buyers' demand is slipping. And based on the numbers that I'm looking at so far this month, it looks like this trend is continuing and is continuing to gain momentum. So what's causing this, and what are the possible outcomes? Could it be because fewer buyers are actually able to afford homes all of a sudden, or maybe because they're sick and tired of the bidding wars and getting seller multiple counteroffers every single time they submit an offer? Or, is it simply because buyers think that a market correction or crash is around the corner? Well, let's look at affordability real quick. So historically speaking in California, the market tipping point signaling the peak of a market cycle has been largely tied to affordability, at least correlation-wise. So for the purpose of this, the Affordability Index defines affordability as the percentage of households that could afford to purchase a home at the median home price based on the median income and financing at the median interest rate for a given area. And as you can see here in quarter one, San Diego County was at 26% affordability. And at the end of quarter two, we were down to 23%. And looking back for several past California housing cycles, we can see that typically the market tends to correct or reverse at around 17% affordability. Now, you can see that 2006 was an exception to this. We actually got down to around 11% due to undue stimulus, all those ninja loans. The government, was propping up the market with all the subprime loans, and we know how that turned out. But statistically speaking, we get around to, 17% is typically the norm going back several housing cycles. And as we currently sit, we haven't hit that typical tipping point. But then again, this is also simply historically speaking, and lending regulations are much stricter and tight today than they have been in the past. So are there any guarantees that prices are going to continue to go up until affordability drops to the level of previous cycles? No, I don't think so at all. And on the other hand, what's the one thing that could impact affordability, the Affordability Index, and move it down even quicker? And well, that's interest rates. And as we can see here, we're looking at the federal funds rate chart showing the overnight lending rate. So as you may already know, the Fed funds rate, or the Fed raises rates effectively by limiting the supply of capital for lending. So while historically interest rates have been much higher than we've been seeing recently, as you can see here, the Fed funds rate was held down for nearly zero for a number of years. And this was via quantitative easing, often referred to as QE. And put simply, QE is essentially when the Fed Reserve buys bonds and mortgage-backed securities and other securities in the open market in a scale so large that it increases the availability of capital, which in turn lowers interest rates. So, finally in 2017, we can see they started actually the reverse of quantitative easing, which is quantitative tightening, or QT. Now, QT works in reverse of QE by pulling liquid capital out of the economy and out of the supply of lending money, which in turn makes it more expensive to come by, thus raising interest rates. And as you can imagine, this directly impacts housing affordability, as the majority of purchases are made with the financing, of course. And if we look here too, just so you can kind of get an idea of we're looking at the Fed funds rate here. So this is going to just be a big picture. You can see interest rates are low, but if we're looking at the average monthly rate that you're actually getting on a mortgage across the country, we can see here, like the most recent one, September 13 is 4.6. And, around this time last year, we're at high threes. So now part of the reason and justification for the increasingly aggressive increases in rates by the Fed is because of the confidence in the national economy. In fact, nearly every single indicator indicates that our national economy is booming. Job growth is strong. Unemployment is reported to be at impressive lows. And GDP growth has been exceeding projections, which is incredible. And not just nationally, San Diego's local economy appears to be extremely strong with bright futures as well. So if this is all true, then how does all this play in the San Diego real estate market? Well, for a period of time, I think we've all had, we've had artificially low interest rates. More and more buyers jumped on the bandwagon in the last several years because of these. And the minute there were two offers on a property, it often became a seller multiple counter offer situation, leading to an extremely competitive atmosphere and contributing to the ego of many sellers and crushing the spirit of many buyers, right? And at this point in time, we are seeing the market cooling and making its transition to a more buyer-friendly market. In fact, if it wasn't for the strong economy, the relatively conservative lending and shortage of physical housing units relative to past cycles, I'd say that we might be seeing the peak of this housing cycle. Now, the truth is, I do not know at this particular time, because I don't know if this is a temporary cooling off of buyer motivation due to housing affordability. But I can say this, my sentiment is that buyers today, in general, seem to be more financially conservative than they were in the past, which I think is also playing into the possibility of affordability levels not getting down and reaching the lows that they have in previous cycles. I mean, the thing is that there are still several variables. How quickly will interest rates continue to rise? If we see slowing in the national market, will the Fed reserve the increases and possibly even lower interest rates? This is a possibility. And if so, we only have a limited margin that rates can actually be lowered before we go into negative interest rate territory, which is a crazy possibility that we'll talk about in another video. I think that part of the challenge which is causing a cool down is that prices have risen and interest rates have risen to the point where selling a home, taking that equity and moving up into another home at a significantly higher interest rate just isn't as appealing to buyers because they're increasing their budget by so much. And on the other side, the first-time home buyers, the increase in rates combined with the housing prices has improved the renting versus buying ratio in favor of renting for the time being. So one thing I think is for certain right now is that the market is adjusting, and as it does so, sellers will need to adapt when considering pricing, because when supply is increased to the point that a buyer has 50% more options to choose from and less sales are taking place, there's only one logical conclusion while these conditions exist, which is lower prices and or more buyer concessions to buyers. Now, the number of units per capita has not drastically increased yet, and there hasn't been significant mass migration out of San Diego. So unless physical inventory drastically increases or population growth reverses or decreases or some other, barring any other major economic changes, either locally or nationally, I don't know how long this cool down trend will play out, because as we discussed earlier, as homeownership goes down, rental demand goes up, and as rental demand goes up, rents go higher, which lead to more frustrated tenants looking to buy. So I don't know. On the other hand, there are other potential variables that could affect pricing moving forward. For example, whether or not the initiative on the November ballot for repealing Costa-Hawkins passes, which would effectively legalize rent control, and that would be up to the local municipalities. So at this point, I would say this. If you are a homeowner and there's a high likelihood that you will need to sell in the next couple of years, I would strongly recommend that you consider selling now, if a decline in the market in the next few years could put you in a precarious position. And if you're a buyer, or maybe someone who's been on the fence up until now, guys, this is a great opportunity and time to jump in and at least look at the market and crunch some numbers, because there is more opportunity, more options now, and we're going to have more negotiating power. So if you want to do that, give me a holler and we can take a look at some numbers or properties. And if you haven't already, be sure to subscribe so that you don't miss the latest information on this changing market as soon as it comes out. And if you found this valuable, I hope you'll share it with anyone else you think should watch it. And please be sure to hit that like button. As always, thanks for watching, and I'll see you in the next video.